Now, the next thing we're going to talk about in the valuation of common stock now is the capital asset pricing model. Now, the CAPM, capital asset pricing model, this was developed by a guy named William Sharpe, and he won a Nobel Prize for this. And the capital asset pricing model is a model that's used very commonly, by the way, but it's used to define required return. What return should you require of a particular investment as an investor? Now, it starts off very simple, and basically it says that the required return, K sub I on an asset I, is equal to two things: the risk-free return plus the risk premium. Now, the risk-free return, according to William Sharpe now, no investor would ever require a return less than the risk-free return. Think of this now as a return that you could get on a treasury bill. And by the way, William Sharpe says you should use the 10-year treasury note. Last I looked, it was about a little less than 3%, but let's just say it was 3%. That's your risk-free return. I can go out and invest in treasury bills, a savings account, or a CD, or whatever it was, take no risk at all, and get 3%. I would never require a return less than 3% on any asset, because I can get 3% on my treasuries, or at the bank in a savings account, or whatever it is you think a risk-free return is. Now, that's a risk-free asset. If I came to you and said, you know, I'd like you to take your money out of the bank, take your money out of that treasury note, and I'd like you to invest it in a business with me. I'm going to go across the street from the university, open up a clothing store, and sell real high-end clothes, you know, $100 shirts, $300 pairs of pants, all that kind of stuff. A lot of risk in that, because students probably can't afford that. But that's the business that I'm trying to get you to put your money into. Now, you might say, well, I would never invest in that, and that's probably true. But at the same time, if I was offering you a risky investment, the question would be, what would be the total return that I would have to give you in order to get your money out of the bank? So if I said, well, listen, I'll give you a 8% return, 10%, 14%, as I keep bidding it up, financial theory would say that at some point you're going to say, you know, that promised return is so great that I'm willing to take my money out of the treasury bill and invest it in this business. And just for sake of argument, let's say that that number is 17%. That's what it would take, that's what I would have to put in writing that I'm going to try and get to you so that you can take your money out of the bank and invest it in this business with me. That's the total return. That's your required return. If the risk-free rate on your treasury security was 3%, if that's what you were earning on your treasury security, then your risk premium is actually 14%. And I want you to note here, the risk premium now is not your total return that you require. The risk premium is the return over and above the risk-free rate that I would have to promise you so that you get your money out of the bank and put it in this business venture of mine. So the risk premium now, don't get that confused with the required return. They're two different things. People often get these two things confused. I don't want you to get them confused. The capital asset pricing model, the required return on an asset now is the risk-free rate plus a risk premium. The way that Sharpe defines risk premium now, he takes the beta of the asset. You might remember this statistic from probability distributions, historical distributions, all that kind of thing. It's the covariance between the stock and the market divided by the variance of the market. But it's the beta of the security multiplied by the return of the market. Now, the return of the market, think of as the expected return, the return we expect in the S&P 500 index. Some broad measure of the market, minus the risk-free rate. Return of the market minus the risk-free rate. Some people call that excess return, the return in excess of the risk-free rate. But nonetheless, multiplied by beta plus the risk-free return, that gives us our required return. This part of the equation right here now, that's indeed how Sharpe defined the risk premium. A key factor in here is beta, and we're going to talk about beta in the next video.